Welcome to The Close. I'm Lindsay Biscaya. Markets will be closing in half an hour from now. But first, let's get to some of the other stories we're following in the BNN Bloomberg newsroom. Silver slid 7% today after topping $80 US an ounce for the first time ever in overnight trading. The precious metal is still higher by more than 155% year to date. Silver is viewed as a safe haven for investors who are wary of heightened geopolitical tensions and other risks, such as the ballooning US deficit. Lululemon founder Chip Wilson is pushing for a board shakeup while the company searches for a new chief executive. Earlier this month, the company announced CEO Calvin McDonald would be stepping down come January. Wilson has nominated 3 candidates to Lululemon's board, including former on-running co-CEO Mark Maurer, former ESPN chief marketing officer Laura Gentili, and former Activision CEO Eric Hirshberg. And the United States is offering Ukraine security guarantees for a period of 15 years as part of a proposed peace plan. That's according to Ukrainian President Volodymyr Zelensky. Now, despite the offer, the Ukrainian president has said he would prefer an American commitment of up to 50 years to deter Russia from further attempts to seize its land by force. And SoftBank Group has agreed to acquire Digital Bridge Group, a U.S.-listed investment firm focused on digital infrastructure, including data centers. The Japanese conglomerate will pay $16 per share in cash for Digital Bridge. This acquisition is part of SoftBank's push to invest in digital infrastructure. And taking a look at the markets this afternoon, the TSX is a little softer today after some record highs over the last couple of days. You can see what it's looked like from the beginning of the year till now. And if we take a look at U.S. markets, also trending down to end the day, the S&P 500 down by 0.2%, Dow Jones down by 0.3%, NASDAQ down by 0.4%. This is all due to, in part, a sharp sell-off of some tech stocks today. And we'll be speaking about that a little later. Our next guest is paying attention to 3 big stories making headlines today. Joining us now to break it all down is Dan Rahinton, portfolio manager at IA Global Asset Management. Dan, it's good to see you. Thanks for taking the time.
Good to see you.
Lots of big stories today. We'll start with NVIDIA investing in some would call struggling competitor like Intel. Why do you think they're doing this?
I think there's an element of you're voluntold to do something, and this would fall in that category where you're effectively told by the U.S. government that it's not enough that the TSMC Arizona facility is starting to come along. You want to make sure that there's a domestic champion, domestically held, and backstopped by the U.S. government. So this was part of the NVIDIA, I would say, more voluntold than anything. But it's also worth saying from NVIDIA's perspective, it's not necessarily a bad idea to have a second foundry in play, because right now all roads lead through TSMC, and TSMC is functioned as the smoothing of the entire semiconductor cycle for the better part of a decade now. So having a second competitor on the foundry side with its 18A process, where Intel was trying to leapfrog TSMC, it's that attempt to really do sort of 2 things at the same time. One, keep the U.S. government happy, and the second thing is to create potentially a second competitor on the leading edge of foundry.
Do you think we'll see more of this in the future? Like, does this move signal an era where tech giants are kind of acting as like bankers to other companies?
I think it's inevitable, because what's different about this conversation, and I know we're going to get to SoftBank in a bit, is it's incredibly capital intensive. So what we are seeing across the board is the releasing of the balance sheets of the big tech companies, the Mag 7, if you will. So the capital intensity of this means that it's almost inevitable that we're going to see different types of relationships like this, where flush balance sheets move to a balance sheet that's a little bit less stable, but the technology is necessary for both.
Okay, let's move on. Another big story today is Lululemon. Chip Wilson calling out a total failure of oversight, now pushing for a new CEO. He's got a couple of names out there today. What do you make of what's happening, the latest? This is a lot of turmoil for this company.
Yeah, I think this is part of an ongoing process for Lululemon, where the first thing I think it's important to talk about is the reason the stock is where it is today, and the proxy fight why it's starting in the way that it has, is that the results have been pretty difficult for a few quarters now. So international has been growing, but that doesn't really matter if your core North American business is barely growing at all, and you're seeing upstart competitors all over the place basically chip away at share. Alo in the athletic wear category being a perfect example of it. So fundamental issues at Lulu, they're doing their best to create and refresh, but clearly it's not enough, and that's precipitating this proxy fight where Chip Wilson clearly has an attachment, as he should. It's the company he founded, and him making a big play to do a big reinvigoration. I think just taking a step back, whether the proxy fight falls in the founder's favor or not, we shouldn't underestimate how difficult it is to do a broad turnaround in apparel and athletic wear as a whole, because outside of hard luxury and high luxury as a whole in the consumer category, it's very competitive. So this turnaround's happening, the Nike turnaround's happening. It's inevitable that Adidas is going to go through its own turnaround cycle as well. So there's a few of these companies that are, call it, on trend, and others that are off trend, and coming back and forth is not very easy. Consumer's tough.
Yeah, and you say turnaround, right? And we have seen a couple economists saying that this is positive for Lululemon. Obviously, it's been a tough year for the company, but maybe 2026 is going to look a little brighter for the company, a bit of a fresh start. We know Elliott Management also involved in this. Do you foresee this as kind of a fresh start for Lululemon heading into the new year?
I do, assuming it doesn't take too long, right? So if this drags on for 6-9 months, then that's a big distraction for the company. But if it's a few months and the proxy fight effectively settles in a way that the company can say all hands on deck on getting consumers back in our store and getting traffic back, then I think it's entirely viable that we see the turnaround of the company. But I just wanted to make the point and say, it's not like you have core technology in the way that you would in NVIDIA or even SoftBank in some ways. This is consumer choice, and consumer choices are fickle.
Okay, yeah, so we've talked about, you mentioned SoftBank a couple of times, and I know we want to get to that before our time is up. SoftBank today confirming it's acquiring DigitalBridge for $4 billion in an all-cash deal. What does this mean, or what does this look like to you, I guess, in terms of the AI landscape and all the spending that's going into AI in the new year?
I think the best way to think about it, and there's been a lot of, call it Masayoshi Son headlines that have come here and there over the past few months. Some where he's selling certain stakes, like he sold a few $1 billion in NVIDIA to buy some basically more open AI. This, as a whole, I would broadly take a step back and read and say the physical infrastructure needed for AI is clearly significant. And compute is the new oil when it comes to this type of world. And this is the bet by SoftBank Group as a whole that we're going to take more, we're going to dabble in more of these types of tech physical assets. So DigitalBridge is basically, think of it as an asset manager, but very focused on physical tech infrastructure, like fiber optic towers, data centers, things like that. This is SoftBank's push further into that. And it's been very clear that that's directionally where they've been going. So is it a bit expensive for SoftBank? I wouldn't necessarily say so. The only issue with SoftBank is that there's a lot of leverage there. So it ends up being a bit of a YOLO stock one way or another, because it becomes leveraged to what you think OpenAI's valuation is. Do you think it's $1 trillion IPO that's going to happen in the new year or not? So there's a lot of pieces to the NAV of SoftBank, as it would be known, and DigitalBridge just adds to it. But what's also added on is a lot of debt, and that's where you need to be a bit mindful.
I wonder.
Sorry, go ahead.
No, continue your thought. Sorry.
Yeah, to take a step back, it does tell you some of the smartest minds in technology, and Masayoshi Son has absolutely been one of those, is telling you that the physical infrastructure is here to stay and we're going to need more of it. Otherwise, he wouldn't be spending billions of dollars in this direction.
Okay, that's all the time we have. Dan Rahinton, Portfolio Manager at IA Global Asset Management. Thanks so much for joining us.
Thank you.
Coming up, we are looking at IPO expectation for 2026. That's next. Stay with us. Could 2026 be the comeback year for the IPO market? Investors and companies are watching closely which sectors will lead, how valuations are shaping up, and whether market conditions are finally ready to support new public offerings. And it may be an exciting new year ahead. And here to expand on IPOs in 2026 is Greg Martin, Managing Director of Rainmaker Securities. It's good to have you join us. Thanks so much.
Great to be here. Thanks, Lindsay.
So before we get into 2026, let's just take a look back at some of what you think are some of the biggest IPOs of the year in 2025. What do you think is the top one?
Well, I mean, we saw, a great opening for a company called Figma that, exploded out of the gate, has softened since then. Figma's, a SaaS business disrupting Adobe's market. We saw in an AI infrastructure space, we saw CoreWeave have a really big debut. It's up about close to 100% from its IPO. CoreWeave is providing GPU infrastructure for AI applications. We saw a big fintech company called Chime. So there were a few big ones, and we finished the year with a really big IPO with Medlink. That said, it still was a relatively meh year in terms of the performance of IPOs and the number. Although it was bigger than it was the last 3 years, we're still nowhere close to the volume that we saw in 2021. And there were a lot of reasons for that. Some of it was just the uncertainty around tariffs. We had a government shutdown, which pretty much, shut the IPO market for the last quarter. And there was just a lot of instability and uncertainty. But I think we're setting up well for a much better 2026.
So you think we're setting up better for 2026 because there's maybe less uncertainty?
Absolutely. When you think about a new issuance, it's fundamentally uncertain. It's a company that hasn't been on the market before. It's been private. It doesn't have any history, any real track record in the public markets. And so you already have uncertainty with a company. You really don't want to have market choppiness as well and volatility in the market. So the best conditions for a good IPO market are stability. Whether it's, interest rate environment, whether it's regulatory, and certainly we obviously had a lot of chaos in 2025. So I think to the extent to which we see a little bit more stability, which I think we're going to have some certainty around tariffs. I think there's a pretty strong view around where the rate environment's going to be. The economy, I think, is generally better than we thought it might end up, for the end of 25 and going into 26. So I think there's a lot of positive. When you look at the VIX is the volatility index. It really tracks where we are in terms of volatility. It's relatively low. It's kind of in the 15 range today, which is a really good marker for a healthy IPO market. And so if those things sustain, and of course we still have risks, there could be another government shutdown. We'll see what happens. There's always geopolitical events that could shake things up. But I think as we sit here today at the beginning of 26, I think we feel we have a very good market for positive IPOs in this year.
Okay, so let's talk about some of the expectations for IPOs in the new year. Canva, an Australian software company, you expect this one to maybe go public?
Yeah, I mean, there's a lot of companies that historically would have been public. Canva's several billion of ARR. Has grown really fast. It's done extremely well in the private markets. Has a significant market cap in the private world. It depends who you ask on this one. They clearly have the heft and the scale and the growth and the metrics to be public. Some people in the company say they might be waiting a year. They just did a round recently. But we think that if the markets continue where they are, they're buoyant, they're stable, we think Canva would be a great IPO in 2026.
There's also rumblings about SpaceX maybe becoming public in 2026. Do you think that might actually happen? It's kind of hard to believe a company like that is still private.
I mean, SpaceX current valuation's $800 billion. There's talks that, it literally defies gravity, figuratively and literally. It has continued even through choppy markets that we saw in 22 and 23. That market cap has continued to go up. It's got a great business. It now has a very successful Starlink business, which is the communication business. Obviously, it has the rocket launching business. There's talks of maybe creating a new data center in space, if you think about that, and how far out that would be. But they're talking about potentially $1 trillion to $1.5 trillion market cap, and maybe a IPO sometime in the second half of 2026, which could be, if it went out, the largest IPO in the history of the markets.
Wow. A data center in space. I have not heard that one yet. Okay, let's move on. When you're talking about crypto, you think Kraken might be up for an IPO in 2026?
Yeah, I mean, Kraken has already filed confidentially. That's out there, and we saw Motive actually file recently. So there's a lot that believe that after Motive, Kraken will be next. Obviously, it's in the Coinbase, so it's a crypto exchange. Those crypto exchanges have been relatively hot, even though Bitcoin has been up and down a little bit. There's a lot of trading volume, a lot of new investors, whether it's retail or institutional, are believing that crypto is a real thing, and they're getting in and trading. And when they trade on exchanges like Coinbase and Kraken. And so the numbers, the financials are certainly there. They have filed confidentially, so I think we believe that they will take advantage of a good IPO market in early Q1.
And just lastly, I wonder, if we're looking at sectors in general, do you think there's any specific sector that's likely to lead IPOs in 2026?
Yeah, it's a great question. I tend to focus, and we see a lot of trading, on our Rainmaker platform. We in particularly in the tech sector. Clearly, there's the AI trade. So companies in the AI infrastructure space, the AI LLM space. So you think of, obviously I mentioned CoreWeave earlier on the GPU infrastructure side. There's another company called Lambda that is also in a similar business. And then there's the big LLMs. There's OpenAI that recently is pricing at around $800 billion. There's Anthropic. There's XAI. So I think there's a possibility of a very big LLM going public, most likely OpenAI, I would expect. So in addition to SpaceX, OpenAI could be that $1 trillion market cap company as well. So I think if one of those big companies goes, it will really drive a successful year. And then you have the companies like Databricks that have talked about going public, and potentially Stripe, which could have been a public company a long time ago. So I think the tech sector will definitely drive the volume because there's so many centibillionaire companies in the private markets that one of those, maybe multiple of those, could go public and really change the game for 2026 IPOs.
So much to watch for. Okay, we'll have to leave it there, but appreciate you coming on. Thanks so much for your time, and Happy New Year.
Happy New Year to you. Thank you.
That's Greg Martin, Managing Director of Private Markets at Rainmaker Securities. Well, 2025 was a year of political change for Canada, no doubt, and we will review some of the biggest moments in politics this year when we come back. Welcome back. 2025 came with a lot of political change. It started with Prime Minister Justin Trudeau resigning and ended with two MPs crossing the floor. All of this playing out while Canada-U.S. relations soured, bringing trade, tariffs, and Donald Trump to the forefront of many decisions. CTV's Annie Bergeron-Oliver reminds us what happened this year in politics.
Just days into 2025, the winds of change were blowing strong as Prime Minister Justin Trudeau announced his tenure was coming to an end.
This country deserves a real choice in the next election, and it has become clear to me that if I'm having to fight internal battles, I cannot be the best option in that election.
The election wouldn't happen until the spring, but Trudeau's plunging popularity with Conservative premiers, his caucus, and eventually the U.S. president had become insurmountable.
Justin Trudeau, nice guy. I think he's a very good guy. I call him Governor Trudeau. He should be governor.
For months, their troubled relationship and Trump's calls for Canada to become the 51st state dominated the political agenda.
Oh, say, can you see?
And even bled into the sports world, where the U.S. anthem was repeatedly booed. The tense tariff war and strained Canada-U.S. relationship becoming the focus of the 2-month-long Liberal leadership race.
Our neighbors want to take us. No way.
From the start, the former Bank of Canada governor was the front-runner, and in the end,
the next Prime Minister of Canada,
Mark Carney, easily won, defeating former cabinet ministers Chrystia Freeland and Karina Gould.
We didn't ask for this fight, but Canadians are always ready when someone else drops the gloves.
The hockey metaphors continued into the federal election campaign that Mark Carney called.
I'm asking for your vote so we can be Canada strong.
But Canada Strong wasn't the only slogan that took hold.
Elbows up. Elbows up.
This ad with comedian Mike Myers caught the attention of Canadians cementing elbows up
Elbows up.
as Carney's go-to phrase.
Elbows up.
The 5-week campaign focused almost exclusively on affordability, Trump, and Canadian sovereignty.
Justin Trudeau and Mark Carney and the Liberals have made Canada's economy weak. They are not strong enough to stand up to Donald Trump.
At the start, the Conservatives, led by Pierre Poilievre, were poised to form government. But by the end,
The night before the election, how many of you voted already?
Canadians voted for a slim Liberal victory, 169 seats, including the riding of Carleton that was previously held by Pierre Poilievre. The Conservatives won 144 ridings. The NDP just 7. Its leader, Jagmeet Singh, losing his seat and his political career.
We may lose sometimes, and those losses hurt, it's tough. But we are only defeated if we stop fighting.
Do you think there should be a leadership review?
The election results triggered questions about whether the Conservatives, who lost a major lead, needed a new leader.
Are you worried about a challenge to your leadership, Mr. Poilievre?
No.
Those leadership questions faded slightly over the summer after Poilievre won an Alberta by-election and Carney was accused of dropping his elbows or caving to Trump by repealing some retaliatory tariffs against U.S. products.
His elbows have mysteriously gone missing.
The elbows down saying has stuck around among critics who feel Carney isn't standing up to Trump. One MP who likely disagrees,
A good day for Canada.
former Conservative MP Chris D'Entremont. The Nova Scotia MP crossed the floor to the Liberals in November, just ahead of a crucial vote on the budget and its $78 billion deficit.
I wasn't feeling that I was aligned with the ideals of what the leader of the opposition had been talking about.
So let's give a warm welcome to our newest member of the Liberal Party.
And he wasn't the only Conservative who felt that way. The night of the Liberals' holiday party, Markham's Michael Ma revealed he was crossing the floor.
Wow, such a big welcome.
Bringing the Liberals one seat shy of a majority government. But it wasn't all good news for the Liberals this year. The environmentalist Stephen Guilbeault resigned from cabinet after Carney and Alberta Premier Danielle Smith announced plans to build a pipeline to northern British Columbia.
Very pleased that the Prime Minister has heard our concerns and responded to them.
Questions about whether a pipeline are the right move for Canada now are expected to dominate the political landscape in 2026. And already, some pundits are speculating that an election call could come next year. Annie Bergeron-Oliver, CTV News, Ottawa.
Up next, the closing bells on Bay Street and Wall Street. Stay with us. And here are the closing bells at the NASDAQ. Fiverr Children's Foundation rings the closing bell. At the New York Stock Exchange, Norex is ringing the closing bell. You're watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on the Bay and Wall Streets today. TSX cooled slightly amid some light holiday trading after some record highs the last couple of days. We also saw a sell-off, particularly in tech stocks, to end the year, pulling the markets down today. You can see that reflected on the S&P 500, the NASDAQ composite. Shares of Tesla, Nvidia, and Meta were down, and Newmont was one of the worst performers on the S&P 500 today, thanks in part to gold prices dropping, a bit of a pullback there, as well as silver. Now, if we take a look at the big moves of the day, big mover stocks of the day, materials and mining stocks were pulling the TSX down today. Perpetua Resources fell about 6%, making this one of the biggest decliners on the TSX. And Arizona Sonoran Copper shares fell by more than 5% after announcing plans to end a partnership agreement with Newton, a Rio Tinto venture. On the flip side, though, it was a better day for the energy sector, at least in the morning it was. Energy Fuels Incorporated was at 5.6%, leading the gainers on the TSX this morning. And that came after the company says it exceeded 2025 uranium production and boosted near and long-term sales expectations. So we saw that jump this morning. It is down, though, to end the day. And for more, we are joined now by Bloomberg's equities reporter, Stephanie Hughes. Stephanie, it's good to see you. We'll start with Perpetua Resources, as I mentioned, reflecting that kind of downturn in precious metals today. What are you seeing?
Hey, Lindsay, good to see you too. So Perpetua Resources, I'm using this as a way to talk about the broader pullback, but that stock is down by as much as 8% today, which was one of its worst days this month, but probably not the biggest decline it's seen. It's a very volatile stock, as are all gold and silver names. But like I mentioned, it's joining other gold and silver names as part of a broader pullback in precious metals names happening today. And it really is a classic profit-taking situation as traders are booking their gains after a year of back-to-back record-breaking rallies in gold and silver. But fast forward to today, spot gold prices are down about 5%. That's its worst showing since October, and silver prices are down by 11%, which was the worst performance since the pandemic in September 2020. So the sell-off is reversing some of reversing some of what we've seen as an eye-watering rally this year, caused by the Federal Reserve cutting interest rates a few times this year, and because of a lot of uncertainty happening around trade and around geopolitics that had traders flocking to these safe haven assets like gold and silver. And some strategists were concerned that the rally that we've seen this year was happening too fast and too soon. So that was lending to some of the precious metals angst that we've seen today. Maybe some were thinking it was a bit toppy, better sell it off now. But I'm not just picking on Perpetua here. We've had other TSX listed gold miners and silver miners like Agnico Eagle Mines, Allied Gold, Orla Mining, and others underperforming the TSX today. So it's just one of those days where the shine's coming off of gold and silver a bit there, Lindsay.
That's been interesting to watch that run up and then pull back. You're also watching Lululemon today. Of course, the founder, one of the biggest shareholders, is calling for a board overhaul, naming a couple of names, maybe 3 or 4, that he would like to see maybe as the new CEO as well. What are you watching there?
For sure, yeah. It's an interesting story, Lululemon. It had one more plot twist before the end of the year. Like you mentioned, founder Chip Wilson has 3 candidates he'd like to nominate for the board of directors, and those include On Holding CEO Mark Maurer, former ESPN chief marketing officer Laura Gentile, and former Activision CEO Eric Hirschberg. So it's kind of interesting that there were a few entertainment background candidates there. Shares didn't react all that much. They were up nearly 1% last time I checked. That's reversing some earlier losses I saw just after the market opened. But it's been an interesting development in a company that's had a few changes lately. The company said earlier this month that Calvin McDonald will step down as the CEO by the end of January, which Wilson called the third total failure of board oversight. So, Wilson's never been somebody to hold back on what his thoughts were, especially when it comes to Lululemon. I also should add that Chip Wilson is still one of the largest shareholders for the company, so he has quite a bit of sway. These candidates are expected to be nominated during the annual general meeting in 2026. So we'll have to stay tuned to see what changes end up being made at Lululemon and what more plot twists come along with it, Lindsay.
Lots to come, I'm sure. Okay, that's Bloomberg's Stephanie Hughes joining us live. Stephanie, thanks for that.
Thank you.
Our next guest says, don't fight the Fed. This upcoming year, we're looking ahead to 2026, but not without exploring the history of market reaction to Fed easing cycles. More on that coming up right after the break. Welcome back. According to our next guest, the #1 rule for 2026 is simple. Don't fight the Fed. After 3 rate cuts last year and more expected ahead, history shows markets tend to perform well during Fed easing cycles. Joining us now to explain what that means for investors and where the opportunities lie is Laura Lau, Chief Investment Officer at Brompton Group. It's good to have you today. Thanks for joining us.
Thanks, Lindsay. Happy holidays.
Happy holidays to you as well. So I guess we'll start with, why do you say don't fight the Fed? Is it because markets tend to do better when the Fed just does what it wants and potentially cuts rates?
Yes. So #1, the risk-free rate is dictated by the Fed, and that's, a formula. That valuation model is used for all financial assets. So when the Fed rates go down, what also happens is, short-term interest rates go down, so it's not as good to hold cash. You're not getting as much of a rate of return. So you tend to chase those riskier assets. And as a result, the stock market, which tends to be one of those riskier assets, tend to do very well.
Okay, so when we're talking about the year that just passed, or 2025, the year we're still in for a couple more days, who are some of the winners, do you think, for the TSX and the S&P Composite in 2025?
Well, I think, the best performing sectors, I would say, are definitely precious metals, the safety trade, also, higher deficits, not just in the U.S., but all around the world. Also, for geopolitical risk reasons, and then also banks. Banks in Canada had underperformed for many years, and what we've seen is that you can argue that we had a recession in Canada. It was definitely a slowdown, and despite that, loan losses, it looks like they have peaked. So as a result, a lot of the banks have done very well, and their earnings also went up. So gold stocks went up, earnings went higher. We saw gold hit, over $4,000. And then again with the banks, we've also saw capital markets do very well. And lending was stable to increasing. So those two sectors really drove the Canadian market this year.
Do you expect those two sectors to be doing just as well in 2026? Do you think they'll have competition from other sectors, or what do you kind of foresee happening, at least to start out 2026?
So what we see happening is really some of the earnings to broaden out. And as a result, we think some of the other sectors will start catching up because, gold was up just so much this year. It's hard for it to repeat that. We still think that gold can go up with geopolitical risks, central banks buying gold, exchange traded funds buying gold, but it's hard to duplicate this year. And then part of the reason the banks have done so well is because, nobody expected them to do so well. As I said, loan losses were much lower than expected, and valuations were also on the low end. Now the valuations are closer to the high end, so I think it'll be a little harder to duplicate such fantastic returns, but we still think those returns will be good in those two sectors. But the other sectors, especially some of the most cyclical sectors, should start doing well.
And still a lot of uncertainty, too, though, as we head into 2026. We've got the renegotiation of CUSMA, the free trade agreement, coming up in January. How do you think that might affect the markets and certain sectors as well heading into the new year?
So the good thing is that CUSMA is the known unknown. Everybody knows that this is coming up for negotiation, so it's already being priced into the market. So what we expect is that we will get some renegotiations, there will be some noise, and there is a possibility that the deal will be worse. It will likely will. About 90% of the goods that are traded between us and U.S. are under CUSMA, and those currently have no tariffs. However, there's a chance that there will be a tariff, maybe 5-10% tariff. That would be probably the worst case scenario. But I think also what we've realized is that in general, Trump in the negotiations has a very high number, or very different negotiations, and with time, we get to a middle somehow. So we think that whatever the market's imagining, it'll probably be as good or probably a little better than expected.
Okay, well, that's good news, because I know we have heard Donald Trump say in the past that he talked about doing away with the free trade agreement altogether. So we'll have to wait and see what happens there when it comes to negotiations. Hopefully that doesn't happen. But before we run out of time, I wanted to get to your stock pick for today, and that is Citigroup. Why are you looking at Citigroup? What do you like about it?
So what we like about Citigroup is that we think this is one of the top beneficiaries of some of the major themes we see. So one of the major themes we see is deregulation. So and it's already starting. So you have to think, since the great financial crisis, the capital requirements for banks have gotten worse and worse. And now with this deregulation, it looks like the capital requirements will come down. And with lower capital requirements, we see that there'll be probably more share buybacks, more loans. So for instance, Citigroup now has $16 billion of excess capital. And that's without any changes to deregulation. So with that money, they can lend more. They can do more share buybacks. So and they have been doing that. They've also been, a beneficiary of AI. They've reduced headcount by 20,000 people. So as a result, we've seen their earnings grow by 25% in 2025 and also 2026. So, and it's also trading at about book value. So when they do buy back shares, it is, fairly accretive as well.
Okay, that's all the time we have. Laura Lau, good to have you on, though. Thanks so much for joining us, and happy holidays. Happy New Year.
Thank you.
That was Laura Lau, Chief Investment Officer at Brompton Group. Up next, we're going to get some more insight as we look ahead to how the markets will fare in 2026. We'll be back in a moment. It's been a great year for stocks, and Wall Street's top forecasters are predicting another solid year ahead. For more, we sat down earlier with BNN Bloomberg contributor John Ehrlichman to discuss what pundits are saying about the market heading into 2026.
This game that the Wall Street strategists play. They don't mind necessarily when they are not quite right, but they hate being wrong because they're paid a lot of money on behalf of these huge institutions to at least be in the ballpark of getting it right. And as we come to the tail end of 2025, here we are again talking about a magical year for stocks. Let's start with the U.S. market through the lens of the S&P 500, because all the way along this upward bull market run, we have seen people say, okay, it cannot continue. But now we're up in the neighborhood of 90%, I believe, since the lows of 2022. And when the strategists stick their neck out with the wrong call, like sell your stocks because this can't continue, sometimes it costs them their job. Literally, we have seen that with some of the bears during this bull run. So we're kind of at that point in the bull market where it feels like the consensus is all in on stocks for 2026. Bloomberg was looking at more than 20 strategists who represent all the big firms across Wall Street, Bay Street, and beyond. And nobody is predicting that stocks will be lower by the end of next year. Now, it's debatable how much more upside there would be. Some think a few percent, some think maybe 10%, maybe even more. But nobody wants to get it wrong at this point. And look, there's still enough on the table that would justify continued gains for stocks. Like if the AI story is very real and a big productivity driver for the economy, there will be certain heavyweights that could benefit the stock market investors from that. If the U.S. Federal Reserve focuses on lower interest rates, there are companies that could benefit from that as well. But it's sort of a sign of the times. Anybody who had previously thrown in the towel has taken that towel back, and they seem to be waving it around for 2026.
And it's not a white towel; it's a red towel, right?
That's right, exactly.
All right. What about? Let's jump over to Bay Street. What are they saying there?
Well, I mean, you were just showing that chart of the TSX. It's been a marvelous year. If things hold, I think we're on track for the best year since 2009. And Bloomberg was actually putting out some interesting analysis about the valuations for the Canadian stock market, arguably not as pricey as, let's say, the S&P 500. We don't have as many of those AI juggernauts in Canada, but we have a few tech names that have been standout. But certainly because of the materials rally, that has really led to a surge in the valuation, so much so that the same question gets asked. If you've got one of the pricier stock markets in the world right here in Canada, when, let's face it, when you look at sort of the Main Street economy, things don't look terrific. Can that continue? And I think that at the end of the day, we'll come back to something we've talked a lot about on BNN Bloomberg, whether or not the commodity boom shows more life in 2026. A lot of people have talked about, a super cycle. If you were to see investors come back to energy while they continue to love things like gold and copper, wouldn't really be a surprise to see more upside for the TSX, but I think in the Canadian market, that just seems to be more of the overshadowing factor, is whether or not that sort of commodities, materials rally continues, in the same way that I think in the US, a lot of people are asking whether the AI story is real or whether it's sort of a bubble that will fizzle out in the year or next couple of years.
Okay, that's broad picture. Let's talk about one that's back in the news again today. Lululemon is back in the news for all the wrong reasons, isn't it?
Well, yeah, hasn't this been a fascinating one to watch?
Oh,
yes,
yeah.
You mentioned it in your newscast. You've got Chip Wilson, the founder of the company, who really hasn't been in the driver's seat for, at this point, about 2 decades, but who has been very vocal. I mean, even though he sold a lot of stock, which led to, in part, his exit from the company, he's still a huge shareholder in the business, and it's charts like this that he doesn't like to see as a large shareholder in Lululemon. So obviously he had been very critical. You mentioned the fact that the CEO, Calvin McDonald, is making his way out. He got the message. But now it looks like, and the Wall Street Journal was first to report this, that he is ready to put his thumbprint, I suppose, on the board of directors, and he wants to bring in a few people that maybe can shake things up. And, you know, I'm not sure that's that much of a surprise, because there's going to be this sort of period where, you know, you've got a CEO transition. That might mean that there's more influence in the boardroom in the short term. You know, does Chip Wilson like what he sees in that boardroom? Clearly, he is looking to make some change here. And I suppose we'll see if any of this can, you know, at least from a management or a sort of a board level, spark some interest in Lululemon, which had been such an amazing stock performer over basically a decade before running into some of this turbulence.
That was BNN Bloomberg contributor John Ehrlichman. John also hosts the Ticker Take investing channel, which you can find on YouTube. Well, from a scrappy startup to a global media giant, we are taking a deeper look at YouTube's evolution over its 20-year history. That is after the break. Stay with us. From a scrappy startup to a global media giant, YouTube has constantly evolved over its 20-year history. Bloomberg Originals examines the platform's legacy and the challenges posed by AI and its biggest competitor, TikTok. This Bloomberg doc dove deeper.
Okay, hi. So, my name is Boxy, and it's been a while since I made a new video.
I first heard about YouTube when I was in high school.
I went to a party with Daniel, and he kissed me.
Just kind of wondering, what is that?
I have this really vague memory.
They have really long trunks.
I believe it might have been the first YouTube video ever.
It was, and featured trunk enthusiast and YouTube co-founder Javed Karim. And it ignited 20 years of liking, commenting, and subscribing. 20 million videos are uploaded to YouTube every day, and the site's estimated to account for about 1/5 of all internet traffic. In the US, people spend more time watching YouTube on TV than Netflix, Amazon, or all of Disney's TV networks and streaming services combined. But the world's central repository of video content is now taking a risky gamble, while also facing its first real competition in years.
The biggest threat for YouTube is that someone could come along and do what they did 20 years ago.
And so, with novel threats knocking at its door, can a wealthy, grown-up YouTube still keep its kids engaged?
You're still here.
YouTube has a knack for survival. Should humanity accidentally deploy a planet-wide exit strategy, Earth may well just be old Nokia phones, Twinkies, and YouTube servers. And it has youngsters to thank for that.
The vast majority of teens consume YouTube content every single day. Most of the products that were popular when I was a teen are either extinct or they're for the boomer generation at this point.
Just imagine MySpace or MSN Messenger holding prime real estate on billions of our home screens.
The site was founded in 2005. Sharing video online was just beginning.
YouTube provided this really easy way for people to just seamlessly share these little moments that might have once been stuck in sort of home video land.
Within a year, YouTube was serving 30 million videos a day to 9 million people a month, with about 30,000 new clips being added every 24 hours. Broadband internet, advances in video compression software, and tools like Adobe Flash combined to help YouTube become the internet's preferred way of broadcasting itself.
One of their major reasons for the success their first year was that people could embed it into MySpace, which at the time was incredibly popular.
Although that made hosting and serving up video files expensive.
One of the founders put up a pretty major bill on his personal credit card.
It had also caught the attention of some deep-pocketed businesses at a pivotal stage in their own evolution.
Google was very worried they would become obsolete if they did not have a social media component to their business.
So it snapped up YouTube for $1.6 billion, enough for the founders to pay off their credit cards, go back and look at some more elephants, and have change to spare. And change really is the operative word here.
This was the beginning of this sort of user-generated internet.
So what had Google actually bought? At the time, a big viral success story was Brie Avery, better known as the character Lonely Girl 15.
Hi guys.
It tapped into what YouTube did best.
I don't really know how my parents would react to this.
She was sort of talking to the audience as if they knew her.
And countless other young people achieved cult status doing the same, including Boxy, aka actress Catherine Wayne.
I was like, I am not trolling. I am Boxy, you see?
The old tastemakers that had kind of determined what would be in vogue, that was starting to change, and YouTube really catalyzed that shift.
Not without some irony and costly legal crises, though, thanks to YouTube's belly full of copyrighted material from those old tastemakers.
And they interpreted it this way that, listen, if someone's going to ask us to take it down, we will, but until then, we're going to keep it up.
That soon came to a head.
It's the latest round of charges and countercharges in Viacom's billion-dollar copyright infringement lawsuit against YouTube.
Viacom ended up accusing YouTube and Google of knowingly putting up that copyright and making money from it.
After 7 years of back and forth, the companies eventually settled. Still, YouTube needed to convince the rest of the industry it was legit. What it did changed the direction of the platform for the next decade. And so began Act 2. Amid the Viacom ordeal and with a global music scandal still in recent memory, Google rolled out something called Content ID.
And that effectively is a piece of software that can detect when copyrighted material shows up in a video, and then it gives the owner the ability to either remove that video or make money from any ads that appear on that. And sort of overnight, that system basically let YouTube coexist with the record labels, with Hollywood studios, with TV networks. And we saw this major shift where they were willing to go to YouTube in part because they saw a commercial pathway.
And a lucrative one. Over the last 5 years, YouTube ads consistently made up 10 to 11% of all Alphabet's revenue, which has roughly doubled in that time from $183 billion to $350 billion in 2024. That year, YouTube ad sales hit $36 billion, almost as much as Disney, Paramount, Fox, and NBC Universal combined. But back to our timeline. In 2010, YouTube introduced the next key feature that would lead to all that.
They built this format called the skippable ad, which seems kind of counterintuitive, but now we're all familiar with this, right?
Skippable ads incentivized marketing departments to create compelling promos that people wouldn't want to ignore.
Whether you own one donkey or dozens, we can help protect what matters most.
And then, this.
When I grow up, I'ma be a supermodel.
In 2012, YouTube made this seismic change in switching over to prioritize what it's called watch time.
This disincentivized clickbaity videos and encouraged users to upload stuff people actually wanted to watch.
Beauty vlogging, makeup tutorials became really popular, video game live streams.
And that's in part why podcasts are really popular on YouTube. People put it on in the background and just keep it on for hours and hours.
The total amount of time people spend watching short clips remains significant, but more time's now given to videos 20 minutes or longer than all the little ones put together. Come to think of it, we should probably have padded this video out a bit more. Have a cat on a keyboard. In its second decade of life, YouTube's enduring popularity with younger audiences brought about new obstacles.
One of the most infamous crises they had to deal with was New Year's Eve 2018. Logan Paul at the time was one of the biggest YouTubers in the world and had gone to shoot this series in Japan.
This forest is also known as the Japanese suicide forest. I should have never posted the video. I am sorry.
YouTube toughened its content policies after this, but vetting the 20 million uploads it says users make each day is notoriously difficult.
There's been, in the mid-2010s, terrorism content on YouTube that people found was being advertised against, and that's just not something that any advertiser wants.
You saw a major boycott of advertisers at the start of 2017 around content moderation issues.
Most returned after content rules were tightened further, and non-compliant videos were removed more quickly. But YouTube now exists in a political era, at least in the US, where aggressive moderation is less popular.
Their trust and safety teams have been really hit hard by layoffs in recent years.
YouTube and Google are both trying to have a lighter touch, not really moderate so heavily.
They'll need to deal with those industry-wide responsibilities while maintaining the unique loyalty of YouTube's users and the 20 billion videos they've uploaded, and do so in the face of unprecedented competition. That will define how YouTube will do from here on out, in its third act.
YouTube has many existential threats: regulatory pressure, misinformation, antitrust issues,
and the new elephant in the room.
The massive repository of videos that YouTube has built up through the years has become this incredibly valuable asset to train AI models.
It doesn't allow other companies to scrape its data, but it kind of gives some wiggle room that Google itself could be doing the scraping for its own AI model.
And so it's a real moral dilemma. You know, in some extreme cases, people think of it as stealing.
And so now there's a real fear among some creators that they have unwittingly armed artificial intelligence to replace them.
Google DeepMind has developed a video generation AI model. And so you type in whatever thing you want to see in a video, and then the AI model will generate the actual content.
Or possibly just vast quantities of junk, so-called AI slop.
And, you know, as that takes over platforms like Google Search and YouTube, it is a challenge for the platforms to wade through more of this stuff.
Although the jury's out on whether this is bad for YouTube.
Fundamentally, it's an advertising company, and if there's more AI content on there, there could just be more advertising.
Talk to people inside the company. Their explanation here is that they are building these AI tools for creators that are going to be incredibly beneficial to them.
Things like translation and dubbing, which can help creators reach foreign audiences.
The words I'm saying right now could be instantaneously in Spanish, in Mandarin. 而且不仅如此，他们还会用我的声音说话，就好像我是一个以普通话为母语的人一样。
But for anyone unhappy with Google's AI strategy, there's now that real alternative we mentioned.
TikTok has become probably the fiercest competition that YouTube has faced in its lifetime. TikTok is not only very popular with the younger generation, it's also probably the first platform to come around and build up a successful creator industry.
YouTube still pulls the greatest number of teenage eyeballs, if you'll forgive the horrific mental image, but TikTok isn't far behind, prioritizing the short, snappy viral treats YouTube used to feast on.
YouTube really needs to remain the go-to place for young people. That is what has kept it at the center of the conversation for so long.
There's a former executive at YouTube that told me this. It was these 3 different stages that every company goes through: joke, threat, obvious. In YouTube's first years, it was kind of seen as a joke. It was dogs on skateboards. It was a ragtag team. It was not taken very seriously. Then its next evolution was becoming this threat, a threat to social media companies, a threat to television in Hollywood. Then it entered a third phase where it is obvious. It's just there. It is the sleeping giant of modern media.
But to keep it that way and defy the metaphorical warheads of politics, AI, and TikTok, YouTube needs the future Lonely Girl 15s and Boxies of the world to trust it. They formed the bedrock of the platform's success, and for the first time, they no longer need to stay subscribed.
I think that's about it. Bye!
Well, the markets may have survived 2025, but are we heading into an even tougher year? Our next guest says global uncertainty is far from over. We've got more on that coming up next. The markets were challenged in 2025, and our next guest argues the world has changed more than we realize, and the consequences of that are still to come in 2026. So joining us to break it all down now is Bill Blaine, CEO of Windshift Capital. It's good to have you joining us today. Thanks for taking the time.
No, it's fantastic to be on with my favorite TV channel.
So this is a broad question to start things off, but in what ways has the world changed more than we realize?
It's been a whole succession of things. I mean, Trump, of course, has been the gift that keeps on giving, well, at least to financial commentators and to market watchers. But it's come at a time when the world was changing anyway, and we've got this big hegemonic shift that's occurring as China becomes more and more important in the global economy. And that whole process has been riled by the way in which we've seen the first year of this Trump administration behave. And that's created all kinds of issues for markets. Now, if you were to look at the sort of standard predictions for next year's markets, they're all making assumptions that Trump's going to cause interest rates to be lowered as he takes over the Fed. And that's all great news for markets. But the world has changed.
The world has changed, and as you mentioned, there is some influence from Donald Trump, or some pressure, I guess, on the Federal Reserve, which is supposed to be a separate, independent entity. How much do you think that's going to factor into what we see at the beginning of 2026?
Well, I think it's going to be one of the big themes is watching U.S. politics. And the first thing will be exactly when does Trump take over and the Fed starts to do his bidding. But of course, we've also got the U.S. midterms coming up. So a lot of what happens will be influenced by just how much pressure they come over. But as I said earlier, the market is assuming that lower interest rates and the liquidity that will pump into the market will create the same kind of conditions that we saw in 2010, where we had all that liquidity from QE, which effectively flooded the market and pushed down bond yields because they were buying bonds, quantitative easing, and that therefore pushed up the price of stocks. So you had all this money that was being generated going into financial assets. Now that happened in a genuine period of very low activity and very low inflation and a completely different financial world than we exist today. If we get the same thing happening again today, which many people expect as interest rates continue to fall, it's going to be massively inflationary at a time when we've got potential recession risks still very apparent. And if you have inflation and recession together, well, we call that stagflation. And again, as I said, that's occurring at a period where we have a very changed financial landscape between two global powers competing for dominance. China, which is already dominating the world around Southeast Asia, places like India now joining them. And then the split that is clearly occurring between the USA and Europe.
Yeah, okay, I want to bring Europe into this as well, because, when we're talking about other geopolitical tensions that you might see as a concern or a worry heading into 2025, the war in Ukraine and Europe's hesitation on funding Ukraine, what does that tell us, do you think, about global stability?
Well, getting Europe to make decisions is a bit like herding cats. It's very, very difficult, and you're going to get scratched. It's proving almost impossible for Europe to agree on simple ways of doing things, and that's because you've got a whole history of 28 nations, all with their own axes to grind. But I'm not so worried. Well, of course, I'm very nervous about what's going on in Ukraine and the potential of it spreading. And we can come back to that in a second. What I think is a bigger geopolitical risk is what's going on China-Taiwan. Now, the chances of there being conflict are elevated in the Southeast Pacific. It's not 100% likely to happen. It's maybe a 5% chance. Who knows? But China's in a very interesting position. They're in a position where if they were to go to war today, there's a good chance that they would be able to persuade America to stay out of the conflict, simply because the Americans know that the new weapons that China has are likely to be devastating against their carrier groups and their first island airfields, Guam and in Okinawa and places like that. So China may be facing a use it or lose it case, because over the next 2 or 3 years, the Americans will develop technologies that will nullify that advantage. But at the same time, China's got this massive problem economically that continuing China's economic position means exporting more and more. And if they declare war against Taiwan and see suddenly Europe close down the door to Chinese exports and America close down the door, which will have all kinds of knock-on effects, that would be devastating for the Chinese economy. So the big place to watch for geopolitics next year is going to be, again, this China-US relationship. And I don't think it's a zero probability that there is the chance of conflict in the South China Seas. If that happens, everything changes completely. And it means that we'll continue to see both sides trying to play gamesmanship. Now, if we were to look at 2025, that was clearly massive wins for China. They won things like rare earths and they beat Trump.
So much to watch for in the next year or so. Bill Blaine, CEO of Windshift Capital, really appreciate you coming on and breaking down just some of the things we'll be watching for. We'll have to have you back to go over the rest of it. Thanks so much.
Cheers.
Well, coming up, hot picks in tech, including one in law enforcement technology solutions. That's after the break. Stay with us. Welcome back. Now it's time for Hot Picks. Earlier, we zeroed in on 3 plays in tech with Andrew Sherman, analyst at TD Cowen, and we kicked things off with his thoughts on Tyler Technologies.
Tyler, we just initiated a couple weeks ago, the buy rating, 650 price target. This is a $20 billion market cap software vendor focused on the state and local government markets. They're the only public player that does that. They're the leader. They sell all sorts of mission-critical software like ERP systems, tax, public safety, education. These are all mission-critical functions of the government. We think they have a durable cloud story, including their cloud migration story as they convert a lot of their on-premise customers to cloud over the next several years. They already earn very high margins, and we see this these margins expanding. We think their AI positioning is great as they have deep customer domain data and domain expertise that they can use to automate a lot of manual functions that exist in these agencies. And the stock has pulled back. It's only about 35 times PE. This used to trade at 50 times earlier this year. And we think we can see multiple expansion into next year.
Now, did you say it's the only supplier for state and federal? Did I hear that correctly?
The only public scale player. Yeah, it's a highly fragmented market. There's a lot of private companies that are smaller that do this, but they're really the leader, and they've been doing this since 1998.
And any competition on the horizon, or are they just always? You're talking about how they're dealing with AI and integrating AI. It feels like they're always on the cutting edge.
Yeah, they compete with various companies depending on which product you're talking about. In ERP, they compete with some of the horizontal players like Oracle and SAP, but they don't see them very much in public safety. They compete with Motorola and Axon, and then there's a bunch of point solutions that they compete with in their other offerings as well. But I really think they have a great position because they're the only one that can offer a full suite of products to the public agency, and you can buy everything from Tyler essentially.
And the governments like one-stop shopping, don't they?
Exactly.
All right, you mentioned Axon. It's also one of the ones you're liking right now. What about it?
Yeah, thanks. Axon's our best idea for 2026. We had that note out in November. This is a fundamentally very strong business. They have high barriers to entry. It's a fully connected hardware software ecosystem. We like to call it the Apple of public safety. They sell tasers, body cameras, software, drones, other cameras. And they have a great AI product now that's their fastest selling product in history. And a lot of that is led by an automated report writing software that is driven through the body camera. It also does real-time translation through the body camera in over 50 languages, which is a game-changing technology. So the stock was one of the highest flyers through the first half of this year. It's pulled back 30% the last 6 months, which we see as an overreaction to the Q3 print. We think this is a very good entry point at 10, 11 times sales. We see a lot of durable growth drivers into the new year, strong momentum in both new markets, including international, which is on fire, enterprise, and then selling new products to its existing customer base. Those new products are AI, drones, and Axon 911, which they just made a couple acquisitions to create that. So I think they have a long runway of durable growth. This company has grown 30% plus for quite some time now, and they're now about $3 billion revenue scale, which is some significant size.
What were some of the concerns that people had with the Q3 print?
The revenue beat and raise was smaller than they had normally been doing. And the bookings growth was a little bit lower, but a lot of that it comes in Q4, and revenue is a lagging indicator. So management on the call was extremely bullish about Q4 bookings and into next year and beyond bookings growth. So I believe in management's track record. I think they've done a phenomenal job running this business. So I think the stock will get back on track with a strong Q4 and guide in February.
All right, let's get the last one in, Titan.
Yeah, Service Titan, the Titan of the trades, as I like to call it. This is another one of our top picks. They're the software operating system for trades businesses. So think HVAC, plumbing, electrical, garage doors, roofing, many more. They're growing mid-20s. They've beaten and raised in their 4 public quarters. They really dominate their market, which is a very attractive one. It's very durable, recession-proof, or recession-resistant. It's a very large TAM with still low software penetration. Many of these businesses still don't use software at all. There's no AI risk. It's a great founder-led management team and an attractive valuation at about 8 times EV to sales. They just had a great Q3 in early December where they debunked some HVAC industry concerns. And we think our 16% growth estimate for next year is conservative and see good upside potential ahead.
That was Andrew Sherman, analyst at TD Cowen. Well, that does it for today's program. Thanks for joining us today, and we will see you tomorrow.